One seed can be enough to trigger a global chain reaction. It can shut down export channels, smash commodity prices, and redraw who holds leverage in agricultural trade. Between 1996 and 2026, 3 contamination events tied to genetically modified crops produced over $2.3 billion in legal settlements. The core conflict is still unresolved, because countries that grow and import the world's food still disagree on what safe means. In this episode, you will see how that split works, why it keeps causing billion-dollar shocks, and why gene editing could trigger the next one if border detection fails. At the center are 2 regulatory philosophies that do not fit together. Washington regulates the final product, so a modified plant that looks, tastes, and tests like a conventional plant can be approved. Brussels regulates the process itself, treating genetic engineering as an inherent risk that requires exhaustive environmental review. For exporters, this creates a moving target where compliance changes at each destination. That divide hardened in the late 1980s, and major trade disruptions since then trace back to it. The U.S. approach was formalized in 1986, when the government chose not to create new biotechnology law. Oversight was spread across USDA, FDA, and EPA, using statutes that were never designed for modern gene technology. That framework favored speed, because agencies were adapting existing tools instead of building an entirely new regime. Investment accelerated fast. By the late 1990s, genetically modified crops were deeply embedded in U.S. farming, and surveys from 1999 found that fewer than 3% of Americans even knew genetically modified soybeans were already on grocery shelves. Europe moved the other way. Brussels adopted the Deliberate Release Directive in 1990 under the precautionary principle, meaning regulators demand strong proof of safety before release and member states can veto approvals. What broke the system wide open had nothing to do with genetics. The bovine spongiform encephalopathy outbreak and dioxin scares damaged confidence in official food safety claims. And when American exporters sent unsegregated genetically modified corn to Europe in 1996, activists branded it Frankenstein food. A de facto moratorium on all new approvals landed in 1998. That policy shock froze innovation for a generation. By 2011, average approval timelines in Europe had stretched to 65 months, while similar approvals in America took under 2 years. The EU once accounted for 1/3 of global agricultural research and development spending, but that share fell to less than 10%. BASF made the shift explicit in January 2012, moving its global plant science headquarters from Germany to North Carolina after a 13-year delay on its Amflora potato, and exiting genetically modified crop development for Europe. Now we get to the money leak that keeps repeating. If one country approves a trait for planting while another has not approved it for import, even trace detection at a border can halt trade. Ships are rejected, consignments are destroyed, and futures prices drop across markets that were not directly involved. The key point is brutal. Biological drift moves faster than legal harmonization. This happened 3 times at a scale that permanently changed global grain trade. The first precedent was StarLink corn in 2000. EPA approved the trait with Cry9C protein only for animal feed because of allergenicity concerns. It was planted on fewer than 362,000 acres in Iowa, which was less than 1% of total U.S. corn acreage. In theory, that made the incident look containable. But pollen drift and elevator commingling moved the trait into human food channels, and traces were found in retail taco shells. The recall wave was immediate and broad. Over 300 products were removed from shelves, and Japan, which bought 30% of all U.S. corn exports, stopped purchases right away. Roughly 124 million bushels became commingled, and the wider corn market carried a 6.8% discount for more than a year, while elevator differentials moved from 7 to 20 cents per bushel. That episode proved that a small acreage footprint can still become a full market event. Aventis paid $110 million in settlement costs, and EPA never issued another split approval after that case. 6 years later, the industry faced LibertyLink 601 rice, an experimental Bayer trait approved nowhere in the world for human consumption. It appeared in the commercial long grain supply across Missouri, Texas, Arkansas, Louisiana, and Mississippi. Zero-tolerance embargoes from the EU and Japan arrived within days. The speed of response showed how little tolerance major buyers had for legal uncertainty. Rice futures fell nearly 14% in 4 trading sessions, wiping out roughly $150 million in grower equity. The full loss picture kept expanding. Total global economic damage was estimated between $741 million and $1.28 billion, while bilateral trade losses between the US and EU reached $421.3 million. More than 11,000 farmers sued, and after bellwether verdicts, Bayer agreed to a $750 million global settlement in 2011. Compensation averaged roughly $310 per acre for crops planted between 2006 and 2010, with some farmers receiving an extra $100 per acre. Riceland Foods separately received a $92 million settlement. Then came MIR162, the case that changed litigation scale. Syngenta secured U.S. approval for the insect-resistant trait in 2010, but China had not approved import use and typically required 2 to 3 years. Both the National Grain and Feed Association and the North American Export Grain Association issued explicit warnings. Those warnings were not vague. They focused directly on export exposure. Syngenta still marketed the seed aggressively to U.S. farmers beginning in 2011. Contamination spread through pollen drift and elevator commingling, and Chinese port authorities detected MIR162 in November 2013. China froze all U.S. corn imports. By April 2014, rejections reached 1.45 million metric tons. Across global channels, 3.327 million metric tons were rejected, diverted, or canceled. This was not only a biosafety dispute, but also a strategic trade filter. Beijing had a domestic motive, because oversupply from 2008 price support programs made a phytosanitary barrier useful for shielding local farmers from cheaper imports. The market damage was wide, not local. Corn prices dropped 11 cents per bushel across the U.S. market. Distillers' dried grains fell by $80 to $100 per metric ton, and soybean prices slipped $20 per metric ton. Canadian farmers alone absorbed $29.7 million in losses during the 2013 to 2014 crop year, while total damage estimates ranged from $1 billion to $2.9 billion. Another $3.4 billion in losses was flagged as threatened if Syngenta released Duracade before Chinese approval. Final settlement value reached $1.51 billion, the largest agricultural litigation payout in American history, and over $503 million of that went to attorneys. From these 3 disasters, courts built the interconnected market doctrine. Under that framework, developers owe a duty of care to the broader agricultural market, not only to direct seed buyers. The logic is physical and practical, because pollen drift makes contamination difficult to contain once traits enter commercial use. Legal responsibility follows market impact, not just contract boundaries. That shift enables strict liability arguments for market-wide economic harm. Power concentration then amplifies every regulatory mismatch. Bayer, Corteva, Syngenta, and BASF now control 51% of the global seed market and 62.3% of agrochemicals. In U.S. corn seed, concentration among the top 4 is 83.4%, with Corteva at 38.3%, Bayer at 33.3%, Ag-Reliant at 6.8%, and Syngenta at 5%. Cotton seed concentration is even higher, at 93.6%, and roughly 95% of U.S. corn intellectual property is held by just 3 firms. When concentration is this high, risk governance decisions become system-level events. The financial pressure on growers is measurable over time. U.S. seed prices rose 270% between 1990 and 2020, while general commodity inflation was only 56% over the same period. Technology use agreements ban seed saving and limit proprietary genetics to a single season, and many contracts include indemnity clauses that shift genetic drift liability onto growers. In some cases, farmers whose fields were accidentally contaminated by patented traits still had to defend against patent infringement lawsuits from the trade owners. Even without a legal fight, segregation is expensive inside a bulk system built for speed. Cleaning a 36,000 bushel storage bin takes 1.5 to 2.5 hours and costs between $21 and $59. Scrubbing a combine to remove residual genetically modified seeds can take up to 8 hours at nearly $80 in labor. Flushing augers can consume up to 75 bushels that are immediately downgraded. Each PCR DNA test adds around $125. Costs keep accumulating after grain leaves the farm. Elevator-level segregation adds 3 to 4 cents per bushel for soybeans and 7 to 8 cents for corn. From country elevator to export port, full segregation costs run about 18 to 22 cents per bushel. In a high-volume, low-margin trade system, those cents determine whether a shipment is competitive. Gene editing has now widened the regulatory split again. If a crop contains no foreign DNA and the change could occur through natural mutation, some countries classify it as conventional. Other countries classify the same product as a regulated genetically modified organism. The same cargo can carry 2 legal identities at once. That single disagreement is now central to agricultural trade finance and compliance risk. Europe has started to adjust, but with limits. Brussels reached a provisional agreement in December 2025, and the European Parliament backed it in February 2026. Category 1 gene-edited plants, with no more than 20 specific modifications and no foreign DNA, are treated as equivalent to conventional crops and exempt from environmental risk assessment, traceability, and consumer labeling. But Category 1 excludes herbicide tolerance traits, which are the dominant commercial application in the Americas, and gene-edited crops remain banned in organic farming. Parliament also pushed to prohibit patents on gene-edited plants, threatening the primary mechanism companies use to recover research investment. Other jurisdictions are moving on different clocks. The United Kingdom passed its Precision Breeding Act with a streamlined notification system. China cut gene-edited crop approval timelines from 6 years to 1 or 2, and Shandong Belagen received China's first safety certificate for a gene-edited soybean. India released Kamala, its first commercial gene-edited rice variety, using CRISPR edits on the CKX2 gene to raise yields by 19%, and committed 500 crore rupees to domestic CRISPR research. Brazil planted 69.6 million hectares of biotech crops in 2024 to 2025, with adoption at 99% for soybeans and cotton, and 96% for corn. This timeline divergence drives financing outcomes. Traditional genetically modified trait development averages 16.5 years and $115 million in direct capital. A 2-year regulatory delay cuts net present value by 33%, and a 4-year delay destroys half of project value. Investors read these delays as probability shocks, not just calendar extensions. Beyond 6 years, many projects move into negative territory and are abandoned. Under permissive rules, gene editing changes the math. Development costs can fall to under $10 million, and the process can shrink to 1 to 5 years. According to the European Commission, reclassifying Category 1 plants can lower regulatory cost from over €1 million per trait to roughly €250,000. That cost gap also determines whether public breeders and smaller firms can enter the market. Running a trait through traditional GMO pathways still makes research 63 to 76% more expensive than conventional breeding rules. Capital is already repositioning around those differences. The global gene editing market reached $4.66 billion in 2024. Forecasts place it above $7.2 billion by the end of the decade, growing at a compound annual rate between 10.2 and 15.88%. Markets are pricing not just science, but regulatory friction and speed. But detection science creates a dangerous legal gap. Many gene edits are single base pair changes that are chemically indistinguishable from natural mutations, unlike older transgenics that contain identifiable foreign DNA. If an importing country applies zero tolerance without reliable detection tools, exporters can face liability they cannot even measure in advance. Rejecting one Panamax vessel carrying 60,000 metric tons can start at $1.5 to $3.1 million in sunk freight costs before demurrage or cargo discounts. PCR panels for GMO events in corn run about $4,703 per 100 tests, covering 10 traits. At farm level, this sits on top of an already narrow margin cycle. By early 2025, corn averaged $4.35 to $4.40 per bushel, down from $6.54 in 2022. Soybeans traded around $10.35 to $11.20 after a 25 to 30% decline. Total farm production expenses hit a record $467.4 billion in 2025. Growers entered this transition with weaker output prices and heavier cost exposure. Input lines show the pressure clearly. Corn seed costs about $110 to $115 per acre, while soybean seed runs around $65 per acre. Soybean producers are estimated to lose $89 per planted acre under current conditions. Non-GMO, identity-preserved soy still paid about $2.65 per bushel in 2024, but those premiums slipped 4 to 6% heading into 2025. Premium behavior follows an inverse pattern that growers watch closely. When soybeans peaked at $14.20 per bushel in 2022 to 2023, non-GMO acreage shrank. After soybean prices dropped 11% in 2023 to 2024, premiums jumped 45%. When prices then fell another 22%, premiums rose an additional 10%. Trade law now multiplies this complexity. Roughly 80% of world grain trade moves on GAFTA standard contracts. The Biosecure Act restricts federal agencies from doing business with designated biotechnology companies of concern linked to China and Russia. In 2025, baseline import tariffs sit at 10%. Some country-specific rates rise to 50%, and up to 82% of active pharmaceutical ingredients still come from China and India, which forces biotech firms to rethink supply chains. Dispute procedure is also tighter than most operators realize. Cases can move into GAFTA or FOSFA arbitration. The appeal period is a strict 28-day window that starts when an award is physically issued, not when parties are notified. Miss that clock, and the commercial result is locked regardless of strategic intent. Underneath regulation and trade law is a longer fight over who controls seed. Hybridization in the 1930s created biological lock-in, because many high-performance traits do not reproduce true in later generations and require annual purchases. Green Revolution varieties spread through public institutions, but also tied farmers to synthetic fertilizer and chemical pesticide packages. Utility patents in the gene revolution of the 1990s completed that enclosure model. Corporate consolidation deepened the pattern. Between 1996 and 2008, Monsanto acquired DeKalb, Delta, and Pine Land, Cargill's seed division, and Seminis. What looked like a market of separate dealers increasingly functioned as a single pipeline for proprietary genetics. In response, the Open Source Seed Initiative launched in 2012, while La Via Campesina continued pushing agrarian reform that rejects commercialization of the right to produce. Digital platforms opened a new control layer. The same firms that dominate seed genetics increasingly operate systems that collect farm-level data on soil health, yield maps, and crop performance. Proprietary platform design can block data portability and trap producers in closed vendor ecosystems. In that environment, farmers can face limits even on basic equipment autonomy, including whether they can legally repair their own tractors. From here, 3 paths are visible. If gene editing rules harmonize, development costs can fall from $115 million to under $10 million, and allow smaller firms and public institutions to compete. If fragmentation continues, trait releases will be delayed until import markets approve, leaving farmers on aging tools as pest resistance accelerates. If full recoil treats all gene-edited crops as strict GMOs, research pipeline values could drop 50 to 80%, startups would struggle to survive, and only the big 4 may remain dominant. A regulatory split that began in the late 1980s is now a geo-economic contest where seed rules function as national strategy, while the farmers who feed the world keep paying for the unresolved argument.